Hi, everyone. Welcome to the webinar today. My name is Alexandra Alvarado. I'm the Director of Marketing and Education here at the American Apartment Owners Association. We are so glad that you could join us today. We have a fantastic webinar ahead of us with a full panel of experts. We have with us a tax strategist, tax attorney, and deferred sales trust expert as well, cost segregation expert. We are going to be talking about the deferred sales trust and cost segregation. The title of this webinar is Do Not Transact a 1031 Until You Know About the Deferred Sales Trust. And we will, of course, be having a Q&A at the end of all of this. So please put your questions in the question box. If you think of anything along the way, we'll try to get to as many questions as possible. The goal is to have the presentation last about an hour, but we will stay for questions if we have a lot and our speakers can stick around. And also, as usual, we are recording this whole thing. So if you miss anything, or if maybe can't take notes for some reason, you can always watch it tomorrow. We're going to email it to everyone with all of our contact information, so you can get in touch if you have more questions or you want to just reread the webinar or review the webinar recording. So with that being said, I'll introduce our first guest here, David Fisher, who is with Creative Tax Strategies. He's going to be talking about the Deferred Sales Trust, and he'll be introducing us today to the presentation. So thank you so much, David, for joining, and for Todd and Sean as well. I appreciate your time and for being here.
Great. Thanks, Alexandra. First of all, let me say I appreciate you going beyond the call of duty to set up this webinar. And for those that know me, know that that's true. So we really appreciate all of your efforts. And hopefully our webinar today will justify all of your hard work. Again, my name is David Fisher. I have a firm called Creative Real Estate Strategies based in Houston. I have had the privilege to work with some great real estate professionals and their clients all over the country. The best part is that it doesn't matter what kind of real estate that you're selling. It could be multifamily, it could be a commercial property, it could be land, ranch, or farm, and even a luxury residential property. It really doesn't matter as long as there's a taxable event. In addition to that, if you're selling a business, we could be a pretty good opportunity for you as well. So with that said, I really appreciate your time. I can tell you we've all worked very hard to try and bring as much value to you in the next hour as possible. We know you're busy, and we thank you for being here. Okay, we are going to talk about an opportunity that most of you don't know exists. And I like to call this opportunity the dynamic duo. Now, when I say dynamic duo, I'm not talking about Batman and Robin. I'm not talking about R2D2 and C3PO. And if you're a big old Western movies fan with John Wayne and Jimmy Stewart and Audie Murphy and the rest, we're not talking about the dynamic duo back then, cattle drives and beans. The dynamic duo we're going to talk about today will put more real estate wealth in your pockets, and it's been proven for years. The dynamic duo that we're going to be talking about is the Deferred Sales Trust and cost segregation. And working together, I'm absolutely confident that we can help you create more real estate wealth. Now, before we get started, a couple things about the Deferred Sales Trust. Number one, most of you have probably never heard of us. And if you have, you probably heard negative things about us, and that's okay. So we're going to clear things up today. The Deferred Sales Trust is proprietary. So it's not as well known as 1031s, but that doesn't mean we're not a great opportunity, because we are. The Deferred Sales Trust has a track record of approximately 30 years. There have been roughly 4,000 times the trust has been used successfully. Every time the trust has been used, it has successfully deferred taxes. In addition to that, there have been roughly 20 IRS tax audits, maybe a couple more, and if there have been, Todd can go into detail with you on that as well. Every time the IRS came in to audit where the trust has been used, the tax attorneys have successfully defended the Deferred Sales Trust every single time. So if you have some people saying, oh, well, what if the IRS says this, or what if they say that? We already know what they're going to say, because they've been through at least 20 tax audits. In addition to that, in 2019, I believe it was, they came in and they did an audit on all of the deferred sales trust documents, the trust documents, supporting documents, court cases, everything. And they left, again, with a no change letter, meaning we have everything wrapped up nice and tight. So we know that we're on solid legal and tax footing. So if you hear anybody say, oh, well, what if the IRS says this or that? Ignore them. We already know what the IRS is going to say. Okay. A couple of quick comments, and then I promise we'll get started. Because our trust is proprietary, only a small handful of tax attorneys nationwide can create and implement the trust, like Todd. Because of that, probably 90 to 95% of all CPAs and attorneys don't know anything about us. That's okay. There's no reason why they should, because again, we're proprietary. So unless they come across us, they're not going to know about us. And that's okay. What we do, and Todd will verify this, he's on the phone every day with CPAs, attorneys, real estate owners, talking about the deferred sales trust. So we can answer any questions that your CPA or attorney may have. The reason I'm telling you this is because one of two things will happen. If you like the things we've said today, and I think you will, you're thinking, well, gee, let me talk to my CPA or attorney about this. Well, you should, but one of two things will happen. Number one, some of them may say, gosh, I don't know anything about this. Well, that's okay. We can get on a conference call with Todd. But unfortunately, what most of them are going to say is they're going to feel that they have to say something, so they're going to say something negative. Because if they said something positive, the question would be, well, why didn't you tell me about this? So they're going to say negative things like, and we've heard all of this, oh, it's a scam. It's a sham trust. My favorite one is, oh, from a CPA, it's an abusive tax scheme. And an attorney recently told one of the people we were working with, they're on the IRS scam list. I didn't know the IRS had a scam list, but if they do, we're not on it. The bottom line is the IRS is the decider in chief, and they have no problems with us. That doesn't mean something may not come up in the future, but as of today, we're good to go. We're on solid legal and tax footing. So if your CPA or attorney says something, get them on a call with us. One last thing very quickly. Because most people that learn about us believe we're a better opportunity than a 1031. So because of that, we're taking business away from these guys, and they don't like that, and I don't blame them. But what's happening is they are trying to muddy the water, and they are saying things that just are not true about us. Let me give you one quick example. About 4 or 5 weeks ago, there was a webinar. There was a video from some 1031 guys, and the title was "The Deferred Sales Trust is Not a Substitute for a 1031." That was really the only thing they got right. They're correct. We're not a substitute. We're a far better opportunity. Now, I'm not going to stand here or actually sit here and tell you that they intentionally tried to mislead people, because I don't know that they did. But what I do know is that they need to get better educated on us before they start saying things about us. For example, the first thing they said, and I would, again, suggest everybody go watch that video, and then feel free to call me or email me, and I'll answer your questions. The first thing they said was the reason our trust is called a deferred sales trust, DST, is to confuse all of you with the more well-known Delaware Statutory Trust, DST, that was created in 2004 from a revenue ruling by the Treasury Department. Well, there's a problem with that. You see, we were here long before they were. We've been around roughly 30 years. They started in 2004. So explain to me how we tried to confuse people when we were here long before they were. So it's things like that that are just not true. And again, I'm not claiming they did anything intentional. They probably just didn't do their homework on us. So if you hear things from them, like this video and a lot of other things we won't go into at the moment, just ignore them. Talk to us. If the trust isn't going to work for you, we'll tell you, because we don't want you to set up a trust and then a month later call us back and say, I don't like it. It's just not for me. Nobody wins in that case. So with that said, finally, let's get started. Let me introduce both of our speakers and then they'll start. Our first speaker will be Todd Jackson. Todd is a tax attorney in Nashville. And in addition to knowing everything and being one of the very few tax attorneys in the country that can create and implement the deferred sales trust, he is also a 1031 QI. So he's got everybody covered. If you decide that a 1031 works for you, and if you decide that, good for you. You may want to work with Todd because Todd is one of the few QIs in the country that can prevent your failed 1031 from becoming a taxable event to you. If he wants to talk more about that later, that's fine. But he can do things like that. Our second speaker will be Sean Lichterman. Sean is one of the leading. Hey, Sean, how you doing? He is one of the leading experts nationwide for cost segregation, and that may be an opportunity that you can take advantage of today. You don't have to sell anything. You may be able to take advantage of it today. And if for some reason you can't take advantage of it today, but you want to sell, then the deferred self trust can help you create more depreciation benefits using Sean. So with that said, I'm going to be quiet, which maybe I already should have done. And I'd like to introduce to you Todd Jackson, who will talk in detail about the deferred sales trust. Todd?
Hey, thanks, David. Hey, good to be here. Thanks everybody for joining and to spend a few minutes with you. Quick background. I'm an attorney. My specialty is tax, real estate, and business is my world. And in addition to that, I'm a real estate agent. I'm a 1031 QI. I'm an M&A advisor. I have an M&A firm. So I kind of deal with anything real estate, tax, business related. So which feeds right into what we're talking about here with our trust structure, because the only time my phone rings on this is when somebody's about to sell something that creates a capital gain, right? And I know most of the people on the call, if not almost everybody, is in real estate, so we'll focus mostly on that. But just by way of background, what we do also applies if you're selling a business, right? Or something other than real estate. So just the concepts that we're going to talk about carry over to those also. So just kind of keep that in the back of your mind in case you do have something else other than real estate. Just know that we can work out a similar structure with those other assets. So a good place to start, I think, is especially with the real estate group. I usually start with a very quick discussion on 1031s. I do 1031s every single day. People tell me, well, if you do these trust structures, you must have something against 1031s. They don't know I'm a QI when they say that. I've done 1031s for 30 years. So I absolutely have nothing against 1031s. They're awesome and they work great when they're a good fit. But over that 30 years, I have figured out something that you probably already know, which is it's not a universal solution. All right. And I'm just giving a few examples of where our trust structure comes in because a 1031 may not be perfect for somebody. So one example, I get a call from a seller. I've got an apartment complex that I want to sell. It's $20 million. It's the sales price. My basis is 8 million and my mortgage is 8 million. Okay. So I got a $12 million gain. And they say, I want you to do a 1031 for me because I want to get out of debt. I want to invest the $12 million. Okay. Well, I have to give them the bad news that no, they're not going to do that in a 1031. If they sell for 20 million, they're going to buy something for 20 million and they're going to replace that $8 million in debt. And they say, well, I don't want to do that. I want to just invest the 12 and not have the 8 million in debt. And so, of course, the conversation has to go, then you're not doing a 1031 because you have to replace that debt. There's no way around that without paying the tax. So that's when we start the discussion because our trust structure is not based on Section 1031. So we're totally outside of 1031. So the rules about 45 days, 180 days, replacing debt, only buying real estate, all of those things are specific to 1031. And our structure is based on installment sale treatment, generally under Section 453, and none of those things apply in 453. So, and I'll get to the structure in just a second, but a couple of other reasons that people will call for 1031s and find out they're not a great fit. Let's say you've got a syndication where you did an apartment complex and you've got investors, right? And you've got 10 investors and they're owners underneath that LLC that owns the real estate. And you're going to sell that project, that apartment complex, and the owners say, well, we want to do a 1031. And you say, well, the LLC is not doing a 1031. Good news is we just made you a bunch of money. Bad news is go settle up with the IRS. 1031 is not an option in that case, okay? Because they're not selling the real estate. So our trust structure can come into play there. So another example. And the reverse of that is also true. I have a lot of people that want to do a 1031. They want to sell real estate, but what they want to replace it with is maybe a syndication like that, to where what they're buying is an LLC interest. Can't work in a 1031. That's personal property, not real estate. So those also don't work for 1031. So as good as 1031s are, and they're awesome, love them, done it for a very long time, there's a whole lot of situations that come up that they're not a perfect fit. So this is something that if somebody still wants to have a deferral of those gains, that's when we implement the structure. So generally the structure works like this. We create an installment sale ahead of the sale of whatever the asset is, real estate or whatever it is. Before any of that's done, we create an installment sale between that seller and a trust that we create. That installment sale, for example, if you've got something to sell for $5 million, we will have the trust established to buy that asset for $5 million. So that installment, and we do that on an installment. So the seller has a note from the trust for $5 million, where it's going to be paid over time. And you already know what an installment sale is. I'm not going to bore you with that. So as they receive payments over time, they're paying tax as they receive those payments, just like every other installment sale. The trust, the way we structure these, is not a related party to that seller, okay? If it were, then everything's collapsed. You can't defer it if it's a related party. So the trust is a totally independent party, independent trustee, independent everything. So the trust then is free after that, since it's not a related party, to sell that asset to the buyer for the cash. We'll call it $5 million. So now what you have is installment sale complete. Sellers owed the money from the trust. Now the trust is free to sell that asset. It gets the $5 million in cash. Now that $5 million then at the trust level is what is used to service that installment note to the seller over time. Okay. And just like every other installment note, it's got an interest rate attached to it, a payment schedule. And that seller then, instead of paying tax on that $5 million all at once, they're going to pay the taxes as they receive payments in installments over 5 years, 10 years, whatever we decide that structure is. So there's the deferral, right? Another way to think about that is instead of taking that $5 million and taking $1.5 million, just to make up a number, $1.5 million tax bill, right? So now they've got $3.5 million to invest going forward after they pay the taxes. Since it is a deferral, since it is under installment, then the full $5 million is available to be invested going forward in the trust to generate income to service that installment note instead of only $3.5 million being invested. Right. So obviously, the $5 million being invested is going to generate a lot more than the 3.5 because it can invest in exactly the same thing that the 3.5 can be invested in. Okay. So that is kind of basically the structure. I'll touch real quick on before questions come in, because I know somebody's going to ask about more recent activity at the IRS about monetized installment sales. You've probably seen that a lot around. Not a surprise to anybody that's in the business. And the difference I'll explain easily. It's all in the name. Okay. They call that structure a monetized installment sale. So monetized means what? I converted that to money, to cash, right? So what that means is that seller, the promoters of that create a structure that looks like an installment sale, but it's not really an installment sale because there's just an intermediary. They don't take title. It's not an installment sale. But then what they do is they take that note that they created and immediately monetize it. They have a lender, air quotes lender, that will loan that seller up to 94% or whatever the number is after their fees on that note. They put that money in their pocket, right? And they're told that that is borrowed money, so they don't report it to the IRS. Well, the IRS obviously disagrees with that. Because they received all the money. That's actual receipt, no strings attached to it. And the installments are not made over time because they've already got the money. So that's why the IRS has it on their dirty dozen list, is that was never going to pass the test. The fact that you could receive all of your money just about and tell the IRS you didn't receive it and you don't owe them taxes. So we've never done that. Obviously, people have asked us to do that, and the answer every time is no, for this reason. It can't work. The installment sale that we do is the real installment sale. There's not any money going back to the seller that they're not paying tax on in the form of a loan or a pledge or anything like that. So just to clear up that distinction, because that question comes up about every day. So now, so the installment is in place. The trust has call it $5 million. Now the trust needs to invest the money, right? Because it owes that seller the installment note with an interest rate, with a return. So that trust invests the funds in anything out there, right? There's really no restrictions on what the trust can invest in. It's generally done according to the risk tolerance provided in collaboration with that note holder, that seller, into things that fit their risk tolerance. Are they conservative, moderate, that type of stuff? Then the trust makes those investments to generate that income over time to service that debt over time. Okay. So and that includes in that return on the taxes that haven't been paid yet. Okay. So you're investing the IRS's money to generate a current income because you haven't paid them yet. You're going to pay them. To be clear, this is a deferral. This is not an exclusion or some sort of a shelter. Taxes are going to be paid later at some point, similar to 1031 exchanges, similar to an IRA, right? If you've got an IRA, you've got IRS money in there. You owe the IRS the money. Nobody questions that, but that's being invested to generate an income or growth in that, and then you can pay the IRS later. This is not the same tax code section, but it works very similar to that. So I've got a question. Let's go to answer. No, one question was, when does the buyer get title to the property from the seller? So if you're talking about what we'll call the ultimate buyer, it gets that from the trust as the seller soon after the installment sale is complete between the seller and the trust. Okay. So if you mean on the buyer, if you mean the trust is the buyer from the seller, when it gets title, sometime before, obviously it has to take title and purchase it and finish that transaction and finish the installment sale before the trust sells it to the buyer, right? So that's got to be the order of things. It can't be reversed, right? I love it. I love questions because I don't like listening to myself talk. The other question, does that imply trust moves to the buyer's name after the sale to the buyer? Right, good question. No. So the trust is not owned by the seller or the buyer, right? Because again, it has to be a third party. It is its own person. It's a taxpayer. It files its own tax return, right? So that trust isn't something that goes anywhere, right? The property does, right? But that trust is a standalone. It is the purchaser in the installment sale. It is the seller into this sale to the buyer. That buyer isn't involved at all in the installment sale. They're paying cash for the property just like they would under every other circumstance. Okay, so they don't have anything to do with that installment. Installment sale is already complete before that buyer buys the property. Okay, so that installment sale is just between the trust and that seller, and that will continue. That installment sale will continue going into the future until all of that money's paid back to that seller by the trust. Okay, so and that can be essentially about any period. Now we start generally with no more than a 10-year term on the installment note. IRS wants it to be commercially reasonable, which generally means something you could get at at about any bank, right? So think of it as a business loan. Banks aren't going to make a business loan for 30 years. 10 years is standard, so that's why we'll do 10 years for the term of the original note. That seller as the bank, okay, think throughout, that seller is the bank. Like any bank, if they choose to at the end of that 10 years, they want to extend that maturity, then that's every lender's call. They can extend that maturity. So the cumulative tax burden from the installments the same as it would be for an outright sale. Yes, the only thing that's different is the timing, right? The gain is what it is. If I've got a $5 million gain from the sale to the buyer, if I sold it to the buyer ultimately, or I sold it to this trust, my gain is the same. The only thing that changes is when I'm going to pay that gain. If I sell it to the buyer, I get the 5 million, I'm paying the gains now. If I do an installment sale, I'm going to pay those gains over time as I receive the money. So as you receive money from the trust, you're going to get three things essentially. You're going to get interest because there's interest rate on that note. So the first money to the seller from the trust is to the extent they're owed interest, okay? To the extent payments exceed what the interest is, then it's principal under that note, just like every other promissory note. And that principal is going to be a combination of tax-free return of basis, as it would have been at any sale, and capital gains for the rest of it. So principal is those two things. And so that will be the case. So the gain's going to be paid the same gain, but it's just going to be paid over time as the principal's paid out. So there's where the deferral is. Good questions, and thank you for those. That's helpful, and sometimes it's easier to explain the process when it's in response to a question. All right, I got one more. In the installment sale, is the title transferred before completion of installments? Is it not a rent on top of? No. So the installment is an actual sale, right? So title has to pass to the trust. It can't be that the trust is an intermediary like in a 1031. To where the trust doesn't take title. That won't work. That's what the monetized installment sale is in trouble for, is it's not a real installment sale. They're not taking title. So the transfer of title is complete to the trust, period, when that installment sale is done. Okay. It absolutely owns the property. It is the owner with the note back to the seller. And now the trust, as the owner of the property, can do what it wants to it. And it sells that to generate the money to pay back the note. So, all right, I love it when I get questions. It says, if you have a short-term capital gain sales transaction, can you use the trust to get a long-term? No, the gain does not lose its character. Okay, so whatever that gain is, not only in amount but the type of gain remains. The fact that you get it later doesn't change the character of it, just only when you get it. Okay. So that's if you have a gain, not to be confused with ordinary income, all right, just because a short-term capital gain is taxed at ordinary rates, it's still a gain, still a capital gain, it's just short-term. And that can be deferred in the installments. All right. I got a few, bunches of them. Now, some of these I might have to respond to later. I'm going to use up all of Sean's time if I answered everyone's questions, but love the questions. And I'm assuming that Alexandra can get me all of these that we can respond to maybe on an email. Or if we have some time when we're done to follow up on a few of those, that's fine. I'll do a couple more real quick. How is original mortgage held by seller paid back to the bank? So in the installment, that mortgage is assumed by the trust. Right now, the timing between that is very short, so it's not something that is out there for any extended amount of time. And so the assumption of that obligation by the trust is a recovery of basis to the seller, right? So it's not, that debt is not retired, and then Section 453 provides how that an assumption of debt is not currently taxed, it's recovery of basis. Now that debt, that mortgage, obviously, when you sell it to when the trust sells it to the buyer, it's paid at that closing, right? And so that's where that gets paid. And one more real quick, and I'll pass over to Sean. What is the benefit to the buyer? Okay, if you mean the ultimate buyer, there's no difference to the buyer. They're paying exactly the same price for exactly the same property. It's totally invisible to them as far as there's no difference to them, and it doesn't change anything for them. So they get exactly what they bargained for. So I'll ask at this point, let me ask Alexandra if there's some way for her to kind of keep these to where we can respond to them later. I will do that, and then I'll turn it over to Sean, but I appreciate you guys having us, and hopefully when we're done, or Sean's done, we'll have some questions we can answer together. Sean, you're up.
Yeah. Appreciate that, Todd. Thank you. And wow, what a wealth of knowledge just in that, 20, 30 minutes of speaking. I mean, we're already seeing lots of questions peppering in. So Todd, if you have time, I guess, feel free to type away, answer those questions. And I'll do the same as I go through my presentation. But first off, hi, everyone. I'm excited to share the stage here today with David and Todd. Obviously, two very prominent figures within the real estate industry. And For those of us in real estate, we're often cash flow and appreciation focused, but I like to take a lot of quotes from the great Warren Buffett, and he once said, it's not about how much you make, but rather how much you save. And I think these two tax strategies that we're covering today, they're phenomenal tools to help you defer your tax liabilities and capital gains. So, let's be honest here. Who enjoys paying Uncle Sam? Surely not me, but I'm excited to cover my part here. Everything cost segregation related and provide a lot of value to everyone. But quick little background on myself. Actually, I come from a long line of real estate enthusiasts. So my grandfather was actually a city developer in Chicago, and my dad was a fix and flipper. So very early on, I've been in and around and investing in real estate. And actually, my first investment property was back in 2009 for 50,000. So I wish I could find those properties still today. But once you've been in real estate for a while, you start to pick up how favorable the tax code is for investors. And actually, my dad initially jumped into cost segregation after many years of being a referral source for him. I too then got into the tax saving business nearly 4 years ago, and boy, business has just been booming. It's a good time, and I haven't looked back since. And actually, you may think to yourself, well, how does a cost seg guy get kind of intertwined with the deferred sales trust? Aren't those different parts of the buyer or the ownership life cycle? And correct, they are. But actually, it's interesting how I stumbled across the deferred sales trust. It's actually from a client referral of mine, and is an individual who's selling their e-commerce business. And like Todd gave a couple of examples here, is going to get hit with a steep capital gain, something to like the tune of like $8 million. So I started scratching my brain, thinking about how we're going to offset this large sum of money. And I can't cost seg his business because there's no physical property, and he didn't want to manage or defer his gains into another like-kind property. And actually, it kind of dawned on me at night. I remember being on a podcast, and the co-host was actually talking about the deferred sales trust. And after a few conversations, this became the best choice for the owner because he was able to establish a plan where those sales proceeds were invested into different funds. And essentially, he was able to retire and live out his days drawing on only the interest from his investments and never getting hit with that full capital gain. So from that experience alone, that really sparked a light bulb moment where I knew my clients had an alternative strategy when exiting their properties. One that is not often riddled with timing or like-kind restrictions. Being in cost seg, I do partner with quite a few QIs, qualified intermediaries, but I typically come into play when a client has failed at identifying like a replacement property, or they simply just ran out of time. So we end up performing what's commonly known as a 1031 light, right? You buy a property, perform a cost seg just to offset that recapturing gains. But again, I'm excited to share the stage here today with Dave and Todd and educating on both of these topics. I actually do have a slide deck, so give me a second while I fumble around and figure out how to pull this up. I believe you go to share screen, make sure I'm sharing my correct screen and not my Amazon list or something. If I can just get a thumbs up from the group, just one of you guys, Todd or David, you can see it. Everything looks good. Perfect. Okay. Well, yeah, so my part, right? I'm the resident cost seg expert, if you will. And my goal today is to simply just explore the world of cost segregation, along with bonus depreciation, related tax strategies, as well as highlight any of the potential risk and considerations. So as I go through here, feel free to drop comments, questions. I'll do my best to kind of DJing my slide deck, the question panels. And if I don't get to them, I'll address them at the end in a reply. But without further ado, right, time's ticking, so let's hop into it. Whoops. Let's go back. There we go. Okay, so for any of my fellow Seinfeld fans out there, you might appreciate this dialogue, right? Very often we hear in commercial real estate investing that cost segregation is one of the greatest write-offs you can apply. But my tax aficionados know all too well that cost segregation is not just a write-off, but it's a tax deferral strategy, right? It's leveraging accelerated depreciation to reduce your tax liabilities. But before defining the strategy even further, I think it's best to know what we're actually comparing this to. As many of you may know that are plugged in here, we can depreciate buildings over a 27.5-year time frame, if it's residential, or a 39-year time frame for non-residential, commercial buildings. And the default method, known as straight line depreciation, applies a consistent rate over these fixed periods. Whereas, when we look at cost seg, it's identifying and reclassifying those assets into shorter depreciation schedules. So think items that are 5, 7, 15 years. This is going to increase the depreciation amount, which then you can apply to your taxable income, which you can then reduce. And ultimately, it's either wiping out or it's reducing significantly the amount you owe to Uncle Sam. So in simpler terms, it's strictly a way to accelerate deductions and create a significant tax savings within the early years of ownership. Let's see, I got a quick question. If cost seg was done and sold to a deferred sales trust, the depreciation will capture paid back at those installments are paid, not all at once like the taxes. I believe I'm gonna tag Todd in with that one as well, where the recapture is not actually when you perform a deferred sales trust, and correct me if I'm wrong here, that recapture is not deferred into the deferred sales trust, correct?
Yeah, so section 453 has an exclusion for accelerated depreciation, right? So if you use a cost segregation that's accelerated, that piece of it can't be deferred in an installment sale, right? Normal straight line depreciation doesn't cause any recapture since 1986, but accelerated can. So we want to watch that to see how big of a piece that is.
Right. Yeah. Thank you, Todd, for jumping in on that. And I see RJ, you've used CSI in the past. Thank you. Appreciate the shout out. But let's get back into it. So, right, the key difference between straight line and cost segregation is strictly just the speed at which you can claim the deduction, right? And we know that the time value of money concept is what makes cost seg a great strategy, because with that tax savings early on, I can put that into further investments. Think things like real estate, more property, upgrades, employees, technology. Hell, I tell my clients, take a trip around the world, right? You earned it. But often I also hear is who can benefit or what asset types does this qualify for? So you can't do it to your personal residence. I wish you could, but you can't. But virtually any brick and mortar business that you pass along the street to, even residential rentals. So like long-term and short-term single-family houses, syndications, as well as certain leasehold improvements can definitely qualify for cost segregation and bonus depreciation, which if anyone caught that bonus, right, it's quite the buzzword as of lately. So let's dive into that real quick. Now, bonus, it's been around for a while, and it really enhances the overall tax savings that a property owner can benefit, especially in the first year. But I like to back up a step, right? Cost seg on its own, it's similar to like hitting a home run at bat, right? It makes sense. We're taking a building, we're deconstructing it, and we're going to reclassify all the components within the proper depreciation schedules, rather than just lumping it all together. But when you apply bonus depreciation to the equation, it's kind of similar to like hitting a grand slam, right? It's drastically increasing that overall tax savings, and it's a very valuable companion to cost seg. As you all can see on the screen here, the current bonus schedule as outlined by the Tax Cut and Jobs Act, it enables property owners to immediately write off, right, a significant portion of the cost of those shorter depreciable assets. So think things like flooring, trim, windows, appliances, parking lot equipment. I mean, a whole plethora of different items that go into this, but they're going to fall into those 5 and 15-year depreciation categories. And a quick misconception or a quick point to note out is that bonus is actually tied to when the building was placed into service, and it's actually grandfathered into that bonus amount. So meaning if I purchase a building between 2017 and 2022, I can still reap that 100% bonus benefit years after the building was placed into service. So let's say I purchased a $1 million building in 2020, and I decided to perform a cost seg now this year, 2024. I'm still going to qualify for the 100% bonus and not the 60% you see on the schedule here. So it's based on the year the property was placed in service. Another thing to note with that is that you actually don't have to amend your tax returns because you've done it in a later year. Strictly just something we file. It's called a Form 3115. Essentially, it's a change in accounting, and you file this to catch up on the depreciation missed. So a lot of my clients are, they're tapping in on this, but if you're like me, I'm sure some of you may have a question on this. are we going to see the 100% bonus again? And if you're like me, I'm glued to the U.S. Committee House reports. You know, there's a good shot that we stand a chance to see the 100% bonus extended from 2023 through the end of 2025. So, you know, fingers crossed, we get a final verdict here, and we get another, as we say in the biz, another honeymoon for 3 years. But yeah, time will tell. Next up, reclassification. So there's a little bit of confusion or misconception between bonus and reclassification when it comes to properties. Reclassification is the percentage of that 5 and 15-year property that's found within a building. And those components are the ones that bonus is being applied to. So the general rule of thumb that we say, you know, if you're doing like a back of the napkin kind of calculation, is that, you know, expect anywhere from 20, maybe 30% on the high end of the purchase price, and that's what you're going to get out of a cost seg analysis. But obviously, as you can see on the list here, certain building types or asset classes perform much better than others, and that could be strictly due to because tax code considerations like car washes and gas stations that, you know, they're going to get a 75 to 100% reclassification, or there just may be more personal property and specialized equipment. But, you know, obviously we're talking on American Apartment Associations of America. So for these types of buildings, you can expect anywhere from 20 to 40%. You know, sometimes more depending on the amenities, you know, if it's A class versus C class amenity. But let's hop in real quick to, you know, example of breaking out cost segregation. And I think this is really going to shine a light on, if you are new to the concept, how it differs from the straight line approach. So here's a 80-unit multifamily complex placed in service last year in April. Now you'll see the purchase amount, 7.6 million, less land. So actually land is a non-depreciable asset, so we have to back that out, which leaves us a cost basis of 6.1 million. Now the way to derive the straight line approach, right, we just take that cost basis divided by 27.5 years. It's going to give us our average, but actually in the first year, it's done on a pro rata style. So it's based on the month and date that property was purchased. So for this particular client, they'd only be looking at 150,000 for their first year of straight line depreciation that they can apply towards their taxable income. Now let's look at the line right under that, 1.3 million cost segregation, right? Quite a substantial difference. Now that's based on, if we see the percent reclass, so nearly a third of this multifamily building has those 5 and 15-year components within it. We take that amount, multiply that by our bonus amount, and that's what we can write off or defer within the first year of ownership or first year of application of cost segregation. So again, 1.3 million is what I can show as a paper loss on our books. If you want to know what the after-tax benefit is, right? Plug in your marginal tax rate, nearly $500,000. What money does cost segregation analysis make sense? Sorry, yeah. So a question came in. So what money does cost segregation analysis make sense on? Very good question. So with bonus at 100%, it's definitely opened it up for, I mean, a wide scale. I've done properties as low as 150,000, 200,000, but certainly the higher up in value, the more you're going to benefit. And that's going to be based on the amount you can accelerate, the type of property, right? Are we looking at like a single family home residential, or are we comparing it to like a class amenity hotel or apartment complex? So a couple of factors there, and then ultimately the fee, right? So let's get down to that. You know, the fee on this particular project, and I loved covering this misconception, is that cost seg is expensive, you know, compared to what, right? Your $10 Starbucks order, sure, I guess it is, but if I can pay $6,700 and get a $500,000 tax benefit, I'll do that all day. Another good note is that the fees are actually tax deductible. So when you submit that with your taxes at the end of the year, it's more like you paid $4,200 on this project, and I'll take 116 to 1 return on investment any day of the week. But like the late great Jerry Maguire once said, right? Show me the money. So to wrap up cost seg, it's faster depreciation, which means you're not getting any more or less when it comes to the depreciation that you can claim on your building. It's just you're taking it on the front end, you're not waiting 27, nearly 30 years to capture it. So when you accelerate it, right, you're going to reduce your taxable income greatly. And let's say, for instance, you don't have any taxable income or it wipes out completely and you have some left over, that's fine. You can actually roll that over into future years until it's all used up. And ultimately, it's just increasing your return on investment in your properties. One of the areas that I love to dive into, especially as of lately, is that the tax deferral or tax savings doesn't just start in a cost seg or even the deferred sales trust. Now, to be fair, these two concepts here really deserve like their own hour of discussion. They're very intricate, so I'm just going to give a kind of a teaser, at least an understanding of what these or how they're applied. But the first one, if you look at the top, partial asset disposition, commonly known as PAD, think of it this way, right? Sure, we're all familiar with one man's trash is another man's treasure. Well, in this instance, your own trash may be your treasure. So in short, your garbage, or better term of words, is your disposed of assets can actually sprout additional tax savings. So the primary goal of PAD is to identify those disposed of assets that still have an undepreciated value to them. And you're going to capitalize that and reap that tax benefit from. So you expense it right away. Additionally, the cost in removing these assets can also be included and expensed. So if you're starting to think of this now, you're like, wheels might be turning. Okay, when I do a renovation or I'm upgrading equipment, that would probably be the time to think of a PAD. Exactly right. And the second one, tangible property regulations, commonly known as the repair regs. These probably are the most recent tax strategies to come into play, in grace real estate investors. They were introduced in 2014, and they're there to provide a consistency across all accounting practices. So think of capital improvements, right? Big, large repairs. You're replacing membranes of a roof on an apartment complex. In general, these expenditures either make an asset bigger, better, faster, stronger, or they keep the asset in its current operating conditions. So that's exactly what these regulations were rolled out for. They're actually mandatory, but they're very taxpayer friendly. And they help distinguish, like I said, right, deductible expenses versus capitalized costs. So I don't want to get too in the weeds because my background is an accountant, isn't a CPA, but I have worked on these with previous clients. But essentially what I want to get across is that if the improvement is considered a repair, it's typically deducted versus a capital improvement and you're depreciating it. So by simply combing through your depreciation schedule, some capital improvements may now be considered repairs and expensed. That's where we're finding the tax strategy, so you do not have to depreciate those large capital improvements. They actually could qualify and be expensed. Quick, kind of blueprint to it. It's a little bit of a cheeky title, but the concept is that no matter what stage of ownership you're in, there's a massive tax benefit or strategy that you can deploy, right? So let's say, for instance, at acquisition, cost segregation is going to make the most sense for you. It's going to provide the most tax savings within the first 1 to 5 years. Partial asset disposition doesn't have to be done through years 2 and 10. It could be done throughout the lifespan, but you're typically renovating a new property within year 2 and beyond. So when you're disposing of those assets, right, think PAD. Again, if you've held the property for a long period of time, you're probably going to be looking into capital improvements. Look at the repair regs. And when the time comes to sell off the building, your exit strategy, think your deferred sales trust, right? It's less hoops, time constraints to jump through, at least something that you consider in deferring your gains through. But all this, right, it can't be all rainbows and lollipops and gumdrops. We talk about cost seg. If it was that great, why would everyone do it? I agree. Everyone should be doing it. But there's a couple scenarios where it just doesn't make sense, right? First off, you got to have a tax liability to offset. If you don't, well, you're not going to feel the initial benefit of this and maybe until years later. Another kind of pushback that I hear most prominent is the recapture tax, right? And if you're holding onto your property for, less than a year to even 2 years at a time, cost seg, again, may not be a beneficial strategy because you're going to have to pay back all of that accelerated depreciation. Cost seg essentially is an interest-free loan from the government. And if you sell it early on, well, the government's going to say, hey, remember that tax savings we granted you early on? Well, where's our piece back? So that's the recapture tax. But thankfully, there's been hundreds of studies showing that as long as the property's been held for 3 to 5 years and that tax savings that you got from your cost seg has been deployed in other either buying more property, you put into renovations, something revenue generating. And it comes back to, again, that time value of money concept that confirms cost seg is very beneficial for you. But even if you can't, right, there's still ways to dampen the blow, in regards to recapture. I won't go through these all together individually, but essentially you can reevaluate your property at the time of sale. So you're putting more of the value in the actual building and less in the personal property. A pad, right? You've disposed of some of those assets, so that actually comes off your depreciation schedule, and then a few others here. Let's see, last we have another example, and this is really just going to drive home when you have those additional tax strategies. It's going to enhance your cost seg analysis, as well as how beneficial it still is applying it even years after you've purchased a property. So you can see here the property was purchased, replaced in service in 2021. They performed this in 2023, so their third year straight line depreciation value is looking at just under 250,000. But cost segregation still, after applying the depreciation that they were already used, was nearly almost 4 times, so 3.5 times greater than what they would have had otherwise. Not only that, if we take a look at their renovations, this, $750,000 they put into it. This is actually the 87,000 is after tax, so nearly a third of the renovations qualified for that pad. So those disposed of assets still had depreciation on them on the books. If you don't capture that, it's actually known as a ghost asset on your books. So you want to capture that in the form of a pad, and you can expense that immediately for that tax year. Again, fee $7,250, more like you paid $4,800, 73-to-1 return on investment. These are highly beneficial. But key takeaways here, right? It's getting pretty close to the end of the hour here, so I'll put a bow on this and we can wrap it up and answer any questions. But the tax code really has a way of balancing itself out. So the concepts here today, they should be properly explored. Discuss them with your tax advisors, your real estate professionals, and just see if it makes sense for you. But if you do have any other questions, feel free to reach out. You can email me here, call me, find me on LinkedIn. It's Sean Lichterman. Last question. So tax relief for American Families and Workers Act of 2024 may potentially allow bonus depreciation 100% for 2023-24. If I file this year based on 60% bonus depreciation and the act passes later this year, will I need to do another cost seg study, or is this managed at the tax return level? Great question, Jeff. Actually, this is one I actually submitted to our internal team about a week ago, knowing how close we are to getting this passed. Like, okay, well, there's probably folks that are going to file in February, March, and April if we don't get a verdict yet. So what I've been told is that the IRS is going to pave out guidance if you have already submitted your tax filing and you've done a cost seg. So we're kind of waiting on that confirmation as well as guidance from the government, but we're also hoping that they get this done in time by the time that the budget is due, by April 15th, right? Because they know they have a lot of people that are going to be filing taxes, and I'm sure they don't want to make up another way around. Maybe I don't know if it'd be another Form 3115, but essentially what I'm hearing from our company, other companies, CPAs, and advisors is that if you can file an extension at the moment, just hold off instead of filing early, and see what happens essentially by April 15th. If it's been passed, great, we can move forward with it. And if you already done, because clients have done their cost segs in 2023, it's a quick change for us. And I would assume it'd be for any other cost seg firm out there as well. There shouldn't be any added cost to it. It's just changing the bonus amount. So great question. Here we go. AJ Jonas. So can you give an example of disposed of asset? Yeah, great question. So in an apartment complex, think of ventilation. Think of ventilation, HVAC, even some parts of your roof, painting, parking lot, if you've repaved the parking lot. So there's a number of items that actually go into qualifying for this pad, but if you've replaced it, and depending on what amount of depreciation is still left on that value of that asset, and you've replaced it, you can capture that difference. But that's my time here, so I'll hone it in, and I'll turn over the mic to David and Alexandra. But again, if you have any questions, feel free to reach out. But thank you for your time today.
Great. Yeah, thank you so much for that. I do have a poll question for everyone to answer. In case you didn't get to on our registration page, if you would like a complimentary tax deferment consultation, you can go ahead and say, yes, I'll connect you over to the team. Whether that's cost segregation or the deferred sales trust, either way, if you say yes, we'll go ahead and prioritize those. We have a lot of people on this call, so please say yes here. It will really help us to prioritize. And I'll leave that up for just a little bit longer. I know we answered a ton of questions, but we still have time if you have any others that have come up since our presenters finished here. Or also, I know that, Todd, you were doing some work on answering some questions, David too. If you saw any questions that we didn't ask out loud, but you would like to maybe have, pulled out just so that everyone can hear them, we can certainly revisit some of those questions you might have answered by typing back to people.
Yeah, I can handle one that came up a few times, and that is there some minimum dollar amount to where a deferred sales trust makes sense, or to under which it doesn't make sense? There's really not a specific number, but just from a practical standpoint, the arbitrary line that a lot of times I'll draw is if your taxable gain is 500,000 or more, the numbers make a lot of sense, right? If your taxable gain is less than that, in the 200,000 to where your tax bill is under 100 grand is maybe kind of a good place to draw it. The trust is going to seem a little cumbersome for that amount. So we generally don't do those unless you've got multiple things to sell, right? So if you've got a $300,000 gain on one property and another 300 on another, and $1 million gain on another, then that 100% makes sense. But if you just got a standalone to where your gain is under 500, it'll feel a little cumbersome for that amount. So that's a question I got a few times. So I want to make sure I responded to that.
Yeah, that's a good question. I also saw Phil that asked, what if the property doesn't sell right away? And Todd, you responded a little bit with the time frame of when the deferred sales trust would come into place. You want to maybe expand on that a little bit?
Yeah, so we have to have the trust in title before it sells it to the buyer, obviously, because it has to own it. And so that's generally pretty close in time to that sale to the buyer. We generally don't put these in place if you're just hoping to have a sale at some point. We generally do it closer to when you've identified a buyer and we're working toward a closing, but we're not there yet. Now, if we do that and that deal falls through, then that's fine, because you're going to go try to find another buyer. And that sale, of course, in the future buyer that you find, they'll be buying it from the trust. So it's really not any different. It's already in place to do that. If that specific deal falls through and then you find another one, then we accomplish the same thing.
Well said. Okay, Colleen asked in the chat, for Sean, if you already did a 1031 years ago, can you somehow use the pad concept?
Yeah, good question. So the 1031, and here's a couple of things that may happen with the 1031 into another property or the replacement property. So when you're deferring the capital gains, the replacement property cost base is actually going to reduce by that amount. So if you're thinking cost seg, there's actually sometimes you can't cost seg your replacement property because there is not enough cost basis left. Let's say I've got a $1 million deferral and I buy two $500,000 properties. Well, that cost basis is now nil. But on the partialized disposition, because you're not deferring those tax savings, you're actually expensing it. You can still perform the expense. You can still perform the pad.
Great. I want to pull out a few questions here that I saw, Todd, you were answering. I did see a new one come in though. Sherry asking, I'm looking at a gain of 400,000. Seems like I am in the middle ground, worth a conversation for either the deferred sales trust. I would say it never hurts to have a conversation, right? So certainly it's not like you have to have a certain amount for sure, but it's a situation by situation thing, right?
And another thing that comes into play is where she is, right? Or where whoever the seller is, because if they're in Tennessee where I am and there's no state income tax, then that tax bill is different than if you're in California and it's almost twice what it is in Tennessee. So obviously the tax obligation is going to vary by where you are. So certainly worth the conversation. Yes, I would agree.
Right. And Todd, you had mentioned earlier some of these questions, whether or not you would get a copy of them. Yes. So if for some reason we haven't gotten to your question, I am sending all the questions to all of our speakers today. So right after this, they'll have a record of getting a hold of you to answer or maybe detail out a little bit more information on those questions. But I think there are a couple more here that weren't asked out loud that are worth mentioning. So Andrew asking, did I hear correctly that this will work for high value residential sales also? And I
Yes.
think the answer is yes, right? For cost seg
Good.
and for the deferred sales trust.
Well, I'll let Sean reply to the cost seg question, but on the trust, yes. Now, the conversation, I always start that with, let's make sure we've done the math, right? So if I'm selling a principal residence for $1 million, right? And my basis is 500,000, but I'm married and I get the 121 exclusion for 500, then I have no gain. There's no reason to do it, right? So that exclusion is important. But if you're in places like California and some other places that I do a bunch of these in for the principal residents, and their gain is $5 million, what people tell me is that's I'm 100% appreciative of the 500,000 exclusion. That's awesome. It just doesn't help me with the other 5 million. And they're painted into a box because if it's a principal residence, they don't have a 1031 as an option, right? So that's where the installment sale comes into place because that can be done with a principal residence. So yes, if the gain is big enough after the exclusion to justify that, then yes, absolutely, that works.
Great. And then for cost segregation, it would just need to be a business, right? If it could be single family residence, but a rental, right?
Correct. Yeah, you can't do it on your personal residence. There's been a couple of times we've looked at if you've taken your personal residence and then you've moved out of it and you've turned that into like a short-term rental, long-term rental, potentially you can do a cost seg, but there may not be enough tax savings benefit for you, even if you've done that. But yeah, it's only going to apply to primarily commercial buildings and then single family home rentals, long and short term.
Great.
Alexandra,
Mm-hmm.
it's David. If I could just make one quick comment about residential properties. We actually did one about a year and a half ago in, matter of fact, your part of the world, the canals of Venice, right next door to Venice Beach. And there was a young lady who had lived there for 30 years. And all of a sudden, one day she wakes up and there's a tent in her front yard. Turned out a homeless man decided he was going to, live in a front yard, and the laws there say he can do it. So she went ahead, sold her property or her residence, used the deferred sales trust, and it worked very well. So, like Todd said, it depends on where you are. It depends on, the situation, but it can very well work, especially in areas where you have high appreciation, like Beverly Hills, Manhattan, all over the country.
Yeah. And Jeff had asked, and I saw Todd, you just answered, what is the maximum installment periods allowable for the deferred sales trust?
Yeah, so the note, the installment note, IRS wants it to be commercially reasonable, right? So, or something you could get, it's a business loan is what it is essentially. Installment sale is treated as. And so something you can get at a bank. And so we don't want to do an installment note like this for 30 years because you're just not going to get that at the bank. So we'll have a 10-year term for that note, right? Now that seller is the bank, they're the lender. And like any bank, if they choose to extend the maturity on that note, they can do that. For example, I might have a HELOC on my house, right? And that term on my HELOC on that loan is generally 3 years. But what happens every 3 years? The bank calls me and says, hey, you want us to extend this? So sure. So now I might have had that for 30 years, right? At 3-year increments. So we just can't start with a 30-year term on the thing because that's not what you do get at the bank. But the lender certainly can extend that if they choose to.
Well, that's good to know. I want to say last call here for questions. So if anyone has any more questions, I'll give you a little bit more time to put it into the question box. I know we're over the hour mark, but willing to stick around if you have another question to ask our speakers. This is a rare opportunity, so definitely make sure you have thought about maybe some potential questions you could ask here. WC Turner asked, what happens if the buyer faults on the payments?
Yeah, so think of an installment sale. Everybody, when you talk about installment sale, the first thing you think of is a traditional installment sale with that buyer, right? So if I'm selling my house to Alexandra, right? And she asks me to be the bank, and then she doesn't pay those installments, right? Well, then of course I'm gonna have to take the house back. I don't know what condition it's in, all of that. In the trust, the trust has cash in it, right? So we don't worry where the money's coming from, it's already there. And that seller, since they're the bank, they're the lender to the trust, in addition to their note, they're getting a security agreement to where they've got a security interest in everything that's in that trust, right? For whatever it's invested in. So they're a secured creditor in that, so it can't go anywhere without their approval, just like if I've got a mortgage on a house, it has to be approved. So what you think of as the traditional risk and installment sale of a buyer not paying really doesn't apply here, because you're not wondering where the money is going to come from or whether they have the money that's already in the trust.
Good clarification there on that. So I think we've pretty much covered all the questions, over 20 questions. So we'll definitely be sending everyone the recording tomorrow. Oh, a last minute question just came in from RJ. Why do you need a trust? Can you do it in a corporation? That's the next question up. Todd, that might be for you. Oh, I think you're muted. Yeah.
I hit mute. Yeah, so the trust generally for a couple of reasons. One, for privacy, one for administrative costs and administration is much easier than having a state filing with a corporation. And what was the last part of that question? It already disappeared. Hang on.
Can you do it in a corporation?
You could, but it just adds a lot of administrative burden.
Mm.
And some extra tax filings and state filings and other things that doesn't really serve a purpose, right? The trust is just easier to administer.
Mm. Okay, and then Phil asked, what protections are there of my assets in the trust from being commingled, sized, or stolen?
Yeah, so the trust does not have funds from any other deals, right? There's not like this trust has funds from all these other deals. It's just for that deal, right? This trust has no other funds other than that seller's funds that are in this one. So there's no commingling. And generally, the trust account is always going to be at a Schwab, at a Fidelity, that has all the protections in place and insurance and all of that protect the money.
Right. And Paul asking, how is the ownership of the trust structured?
Okay, good question. So the professional trustee that does this, these structures, is the owner of that trust. Okay, so it's structured as a business trust with that trustee as the owner for the reasons we started with, which is if that seller owns it, collapses, no deferral because they own it. If they're the trustee of it, also collapses it because they're related. So it has to be totally separate. So the relationship, the easiest way to say it, the relationship between that seller and the trust is an installment sale relationship, lender borrower, period. There's no other relationship between them. You got a secured lender and the borrower, which is a trust. That's the relationship that makes it work.
Okay, and Colleen asked, does the trust need to do tax filings?
Yes, it has. It's its own taxpayer. It has to file its own tax return. Absolutely, yes.
Okay. All right, guys, I think this might be it. Wonderful presentation. I'm so happy when we have more than one expert come in and really give us a very wide angle of what we can do for deferring taxes. So this was amazing. Again, I'm going to send the recording to everyone tomorrow. We'll go ahead and give you the speaker's contact information. I'll share Sean's slides with you. And then if you need anything else or have any questions, you know who to reach out to. And we'll be in touch tomorrow. I hope you join us for our next webinar, which is going to be about the Corporate Transparency Act. Todd, and maybe you're familiar with that a little bit. So definitely a new requirement, for better or worse, that we need to comply with. A lot of you will maybe need to, some of you may be exempt, but I definitely encourage you to join that webinar next week. I will put an invite in the follow-up email to that as well. And I hope everyone has a happy Thursday. So
Thank you,
on
everybody.
that note, thank you, everyone. Take care, and we'll send you the recording soon. Bye.
Have a good day.